Hi, folks. This is Big Mike Zlotnik. I'm recording this on February 14th. Happy Valentine's Day. And we just got an update on the inflation data. The year-over-year inflation has increased at 6.4% rate. This is slightly higher than the consensus of many economists to be 6.2 year-over-year. And a month-over-month inflation from previous month was 0.5% higher. So effectively, we're seeing inflation still persistent. It has been decelerating since the peak over the last summer, where it peaked a little over 9%. The general consensus on the expectation of inflation by the end of 2023 is that the inflation should be in the 3 to 3.5% year-over-year range. And we're going to continue to decelerate over the upcoming months as the Fed has pushed interest rate up and they're still increasing the rate. The likelihood of increases is pretty limited at this point. About 25 to 50 basis points is what most economists believe will be the additional increase. The terminal rate of the Fed funds rate should be around 5.25 in that, plus minus a quarter probably. So they're almost done. And at this point, they're just going to hold steady. That's the plan. This data was neither disruptive nor way out of line on the expectation spectrum. So the likely plan will proceed. There will be most likely, as I said, 2 more quarter bumps, although they might decide to keep it to 1 and just see what the data will show. They're taking obviously a very scientific approach, data-driven approach, and the likelihood of rate cuts starting late this year is pretty low. So at this point, Fed in general has held Fed funds rate at the peak, the local peak on the local cycle for 6 to 12 months before they start easing. So they're still tightening. Probably by the end of Q1, they'll stop, hold it 6 to 12 months. More like in this cycle, it sounds like it's going to be somewhere 9 to 12 months is a more realistic figure, unless something really bad happens. So that always is a wild factor. Unless something breaks in the economy, something substantial becomes a concern, the Fed will just hold. So what does that mean for most investors? It just means this elevated interest rate environment, and it's going to be pain for folks who have to renew their maturing loans, short-term loans. And this is not just for the real estate. This is true for corporate debt. This is true for any kind of loans that were fixed. The rate was fixed a few years back, and now it's maturing. There's a lot of pain to renew at a high interest rate. I recorded a separate video on what is going to be the experience of most of the operators and borrowers in real estate. These higher interest rates substantially increase the payment factor versus what these bridge loans cost just a couple of years ago. And it doesn't mean that the projects will fail. It just means that the project will be dealing with substantial impact on their cash flow, impact on the actual cash that they need to sustain at least a break-even point on a cash basis. So all those things do matter. And the economy could go into a recession. At the end of the day, that's what everyone has been saying. The likelihood of recession of this phase at some point later half of the year is substantial. The yield curve has been inverted, and the inversion is significant. An inverted yield curve is typically has a 90% correlation to a recession ahead. So again, recession doesn't mean it's going to be severe. It doesn't mean it's going to be like 2008. We don't know what it's going to be. Nonetheless, something to keep in mind. And we actually need a recession, in a matter of speaking. We have a strange situation with a very, very high employment, very full employment, low unemployment, partially caused by COVID, by the fact that the legal immigration in the United States has been subdued during COVID. and the country's birth rate is not sufficient to support the growing economy. So the need for immigration is significant. So anyway, this was just a quick commentary on the state of affairs in the inflation world. Appreciate your tuning in. Until the next time, thank you kindly.